Welcome back, fellow viewers, to another captivating episode of our YouTube series on global financial events. Today we delve deep into the heart of China, where a brewing storm has been making headlines worldwide. Strap yourselves in as we explore the gripping tale of China's mortgage crisis, failing banks, and the eruption of protests that have sent shockwaves through the nation. Is China's long-awaited financial crisis finally here? Let's find out. China, known for its rapid economic growth, has experienced an exponential rise in its housing market over the past 2 decades. However, beneath the facade of prosperity, a severe mortgage crisis has been quietly taking shape. With soaring property prices, mounting household debt, and an increasingly fragile financial system, the perfect storm seems to be brewing. Once considered pillars of stability, Chinese banks are now showing alarming signs of distress. A toxic combination of reckless lending, dubious financial practices, and a surge in non-performing loans has pushed several major banks to the brink of collapse. We'll uncover the shocking details of these institutions teetering on the edge and examine the ripple effects that could shake the global economy. The mortgage crisis in China has put banks on the brink, posing significant risks and challenges to the stability of the financial system. Here, an in-depth exploration of the risks faced by banks and the challenges they encounter. A. Rising non-performing loans, or NPLs. The mortgage crisis has the potential to result in a surge of non-performing loans for Chinese banks. As property values decline and borrowers struggle to meet their mortgage obligations, banks may face a substantial increase in NPLs. This can weaken banks' balance sheets, erode profitability, and limit their capacity to lend to other sectors of the economy. B. Capital adequacy concerns. A surge in NPLs can strain the capital adequacy of banks. Banks may need to allocate more capital to cover potential loan losses, which can limit their ability to lend and impede the flow of credit to businesses and consumers. Ensuring that banks maintain sufficient capital buffers becomes crucial to withstand the impact of the mortgage crisis and maintain financial stability. C. Liquidity pressures. The mortgage crisis can lead to liquidity pressures for banks. A sudden increase in loan defaults or a decline in property values can reduce the value of collateral held by banks, making it challenging for them to access funding in the interbank market. Liquidity strains can further restrict lending activities and pose risks in overall functioning of the financial system. D. Contagion risks. The interconnectedness of banks in China's financial system raises the specter of contagion risk. If a significant bank faces severe financial stress or collapses due to the mortgage crisis, it can create a ripple effect throughout the banking sector. This contagion risk can undermine confidence in other banks, leading to deposit withdrawals, liquidity shortages, and a broader systematic crisis. E. Regulatory challenges. Regulators face significant challenges in maintaining the risks posed by banks on the brink. Striking a delicate balance between supporting banks to weather the crisis and implementing measures to safeguard financial stability is crucial. Regulatory bodies must closely monitor banks' capital adequacy, liquidity positions, and risk management practices to ensure they can withstand the impact of the mortgage crisis. F. Policy responses. The Chinese government and regulatory authorities must deploy effective policy responses to address the risks faced by banks. This may include providing liquidity support to banks, implementing targeted measures to address NPLs, and ensuring that banks have adequate capital buffers. Policy measures must be designed to strike a balance between supporting banks and holding them accountable for prudent lending practices. G. Confidence and investor perception. The risks faced by banks on the brink can impact investor perception and confidence in the Chinese banking system. If investors perceive a high level of risk or lack of transparency, it can lead to capital outflows, reduced foreign investments, and increased borrowing costs for banks. Restoring confidence becomes crucial in maintaining stability and attract the necessary funding to support the recovery of the banking sector. Addressing the risks faced by banks on the brink requires a multifaceted approach. Regulatory bodies must collaborate closely with banks to assess risks, implement prudent risk management practices, and ensure the overall health and stability of the banking sector. Transparent communication and proactive measures are essential to maintaining confidence in the system and mitigating the potential systemic risks stemming from the mortgage crisis. As the mortgage crisis unfolds, the Chinese population has taken to the streets to unprecedented numbers. Protests, once rare in this tightly controlled nation, are now erupting in various cities, with citizens demanding answers, justice, and a fair resolution to their housing woes. We'll dive into the underlying reasons for these protests and shed light on the brave individuals who are standing up against the system. China's financial stability has far-reaching implications for the global economy. With China being the world's second-largest economy, any cracks in its financial foundation sends shockwaves across international markets. We'll explore how this crisis has the potential to trigger a domino effect, affecting global trade, investments, and the overall stability of the financial system. The world has witnessed various financial crises throughout history, each with its unique characteristics and lessons to be learned. By analyzing past crises, such as the subprime mortgage crisis in the United States and the Asian financial crisis, we can gain valuable insights into the potential outcomes and policy responses to China's mortgage crisis. Here are some key lessons learned from past financial crises. A. Asset bubbles and speculative excesses. Financial crises often stem from unsustainable asset price bubbles fueled by speculative excesses. The subprime mortgage crisis in the United States demonstrated how a rapid increase in housing prices, fueled by lax lending standards and excessive risk-taking, eventually led to a collapse in the market. Understanding the warning signs and implementing measures to address speculative excesses become crucial in preventing a similar scenario in China. B. Regulatory reforms and supervision. Financial crises highlight the importance of robust regulatory framework and effective supervision. The Asian financial crisis prompted many countries in the region to overhaul their financial systems, strengthening regulatory institutions and enhance risk management practices. China can draw upon these experiences to reinforce its regulatory framework, improve transparency, and enhance oversight of its financial institutions. C. Contagion risk and global spillovers. Financial crises have the potential to spread rapidly across borders, leading to contagion and global spillover effects. The interconnectedness of financial markets and economies mean that a crisis in one country can quickly transmit shocks to others. China's mortgage crisis must be managed with a keen awareness of its potential impact on the global economy and the need for international cooperation to minimize contagion risks. D. Managing moral hazard. Financial crises often involve issues of moral hazard, where excessive risk-taking is incentivized by the expectation of a government bailout. The experience of the subprime mortgage crisis highlighted the importance of striking a balance between providing support to the financial system and holding institutions accountable for their actions. It is crucial for China to address moral hazard concerns and establish mechanisms that encourage responsible behavior and risk management. E. Communication and transparency. Effective communication and transparency are essential during times of crisis. Clear and timely communication of policy measures, risks, and government actions help build trust and confidence among market participants. China can learn from the experiences of other countries in terms of transparently communicating policy decisions, addressing market concerns, and managing expectations. F. Strengthening financial infrastructure. Financial crises often expose weakness in financial infrastructure such as payment systems, clearing mechanisms, and credit rating agencies. Strengthening these infrastructure components is crucial to ensure the smooth functioning of financial markets and to enhance market resilience in times of crisis. China can focus on bolstering its financial infrastructure to mitigate risks and improve the efficiency and stability of its financial system. By drawing on these lessons, China can develop a robust policy response to its mortgage crisis. Applying best practices from the past crisis, such as implementing prudent lending standards, enhancing regulatory oversight, and fostering transparency, can help mitigate risks and build a more resilient financial system. Learning from the mistakes and successes of other countries is vital in navigating the complexities of the mortgage crisis and charting a path towards a more stable and sustainable future for China's economy. In response to the escalating mortgage crisis, the Chinese government has implemented a series of measures aimed at stabilizing the housing market and mitigating financial risks. However, navigating the complex web of challenges posed by the crisis presents significant policy challenges. Let's delve deeper into the government response and the obstacles they face. A. Stricter lending regulations. To rein in excessive lending and speculative activities, the Chinese government has introduced tighter lending regulations. This includes higher down payment requirements, stricter income verification, and caps on loan-to-value ratios. While these measures aim to curb risky lending practices, they also pose challenges for potential home buyers, particularly first-time buyers or those with limited financial resources. B. Increased oversight of banks. The government has ramped up its supervision of banks, particularly in relation to their exposure to the real estate sector. Authorities are closely monitoring lending practices, liquidity levels, and the overall financial health of banks. However, striking a balance between ensuring the stability of the banking system and maintaining adequate credit availability to support economic growth is a delicate task. C. Curbing speculative investments. The Chinese government has implemented measures to curb speculative investment in the property market. These include restrictions on multiple property purchases, increased scrutiny on foreign investments, and efforts to discourage short-term flipping of properties. While these actions aim to address speculation and cool down the market, there is a constant challenge of striking the right balance between stability and maintaining a healthy level of market activity. D. Affordable housing initiatives. Recognizing the importance of housing affordability, the Chinese government has initiated various programs aimed at providing affordable housing options. These initiatives include the construction of subsidized housing units, rent controls, and support for low-income households. However, meeting the vast demands for affordable housing and ensuring the effectiveness and equitable distribution of these programs remains a persistent challenge. E. Policy coordination and implementation. Coordinating policies across different levels of government and ensuring their effective implementation poses a significant challenge. China's vast size and regional disparities make it challenging to implement uniform policies that address the specific needs of different regions and cities. Balancing local autonomy with centralized control is an ongoing challenge for policymakers. F. Balancing stability and economic growth. The government faces the daunting task of balancing the need for stability in the financial system with a broader goal of maintaining economic growth. Stricter lending regulations and efforts to curb speculative investment may dampen economic activity in the short term, impacting industries reliant on the real estate sector. Managing the trade-off between stability and growth presents a complex policy challenge. The Chinese government's response to the mortgage crisis requires a multifaceted approach that addresses systemic risks, promotes housing affordability, and supports sustainable economic growth. It necessitates ongoing policy adjustments, continuous monitoring, and close coordination amongst various government bodies. Striking the right balance between stabilizing the housing market and ensuring access to affordable housing for citizens is a formidable task that requires innovative solutions and adaptability to evolving circumstances. The Chinese government's response to the mortgage crisis is met with several policy challenges. Stricter lending regulations, increased oversight of banks, curbing speculative investment, and affordable housing initiatives are part of the government's arsenal. However, effectively addressing these challenges while balancing stability and economic growth remains an ongoing struggle. Policy coordination, regional considerations, and a nuanced approach are crucial elements for navigating the complex landscape of China's mortgage crisis. China's mortgage crisis has raised concern among foreign investors who have significant exposure to the country's real estate market. The possibility of a financial meltdown and collapsing property prices has led to uncertainty and a cautious approach from international investors. We'll examine the implications for foreign direct investment and the potential impact on global capital flows. Real estate investments. Over the past few decades, foreign investors have poured billions of dollars into China's real estate market, attracted by the potential for high returns. However, the mortgage crisis and the looming risk of a property market collapse have put their investments at risk. Foreign investors are concerned about the erosion of asset values, potential defaults on property loans, and the limited exit options if they need to liquidate their investments quickly. B. Financial system stability. China's mortgage crisis has exposed weakness in its financial system, particularly with regard to lending practices and banking regulations. Foreign investors are concerned about the overall stability of the Chinese financial system and the potential for a broader systemic crisis. They worry about the impact on their investments in Chinese banks, bonds, and other financial instruments. C. Regulatory environment. The Chinese government's response to the mortgage crisis and its regulatory interventions raise concerns among foreign investors. Heightened scrutiny, stricter lending regulations, and the potential for new policies aimed at stabilizing the housing market can have significant implications for foreign investors. Uncertainty surrounding government actions and their impact on property rights, investment rules, and market access add to the unease felt by international investors. D. Currency and exchange rate risk. China's mortgage crisis can have implications for the value of the Chinese currency, the renminbi, RMB. A financial crisis may lead to depreciation pressures on the RMB, which could affect the returns and repatriation of funds for foreign investors. Exchange rate volatility adds another layer of risk to their investments in China. E. Economic slowdown and spillover effects. A severe mortgage crisis and a subsequent economic downturn in China can have spillover effects on the global economy. Foreign investors are concerned about the potential impact on their home countries' economies, financial markets, and exports. Reduced demand from China, disrupted supply chains, and increased financial market volatility can negatively affect businesses and investments worldwide. Foreign investors are closely monitoring the situation, assessing the risks, and adjusting their strategies accordingly. Some investors may adopt a wait-and-see approach, reducing their exposure to Chinese assets until the crisis stabilizes. Others may explore diversification options, shifting investments to other markets perceived as less risky. The response of international financial institutions and regulatory bodies is also crucial. They play a role in facilitating dialogue, promoting transparency, and ensuring that proper risk assessment and management practices are in place. The collaboration between Chinese authorities and foreign stakeholders become essential in addressing concerns, maintaining investor confidence, and working towards a more stable and transparent investment environment. Foreign investors are grappling with significant concerns regarding China's mortgage crisis. The potential for a financial meltdown, property market collapse, regulatory uncertainties, and spillover effects are all factors contributing to their cautious approach. Monitoring the situation, engaging in open dialogue, and implementing measures to address investor concerns are vital for preserving investor confidence and sustaining foreign investment flows in the face of the crisis. As China's mortgage crisis intensifies, a risk of contagion becomes a pressing concern. The interconnectedness of global financial markets means that a severe crisis in one country can quickly spread to others. We'll examine the potential channels of contagion and assess the vulnerability of other economies, particularly those with close ties to China. Additionally, we'll discuss the measures that central banks and international financial institutions may take to mitigate systematic risks. Firstly, the exposure of international banks to Chinese banks and the Chinese real estate market raises concerns. Many global financial institutions have significant investments and lending activities in China, making them vulnerable to the potential collapse of Chinese banks or a sharp decline in property values. The ripple effects could result in substantial losses and a contraction of credit availability, impacting financial institutions worldwide. Secondly, the interconnectedness of global trade and supply chains means that a significant disruption in China's financial system could have far-reaching effects. China plays a central role in global manufacturing and trade, with numerous multinational companies relying on Chinese factories and suppliers. A severe economic downturn in China could disrupt supply chains, leading to production delays, reducing export volumes and a negative impact on global economic growth. Moreover, China's status as a major consumer market also contributes to the potential for contagion. If the mortgage crisis triggers a sharp decline in consumer spending, both domestically and abroad, it could have adverse effects on businesses reliant on Chinese consumers. Industries such as luxury goods, tourism, and automotive sectors could experience significant setbacks. To address the contagion risk, central banks and international financial institutions closely monitor the situation. They stand ready to provide liquidity support and coordinate measures to stabilize global financial markets if necessary. Collaborative efforts among central banks and policymakers are essential to prevent a localized crisis from spiraling into a broader systematic meltdown. The lessons learned from previous financial crises, such as the global financial crisis of 2008, emphasize the importance of proactive and coordinated responses. Early detection, transparent communication, and swift policy actions are crucial to restore market confidence and contain the contagion risk. International cooperation and policy coordination becomes critical elements in safeguarding global financial stability during times of crisis. The contagion risk stemming from China's mortgage crisis poses a significant threat to global financial stability. The interconnectedness of financial markets, trade relationships, and supply chains means that a severe crisis in China can have far-reaching consequences. Monitoring the situation, implementing appropriate measures, and fostering international collaboration are vital to mitigate the risks and maintain stability in the global financial system.